Hey guys, it's Nick and welcome to another video. Today we're going to look at how dollar cost averaging can reduce your stress while investing. You might be stressed at the moment. There's lots of headlines going around like, are we in a bubble? Has the stock market peaked? Should you be investing right now? Well, I've got some really interesting data to show you which has a less emotional view on where the market is right now, followed by some thoughts from me. After this, we're going to check in to see how my Vanguard portfolio's gotten on over the last week. A day after my last upload, we did hit a new all-time high. But we also have news from four of my biggest holdings in Microsoft, Apple, Tesla and Facebook on their latest quarterly earnings, so we'll see how they've gotten on. As always, I'll wrap up the episode with your questions from last week. But before we jump into the video, please consider giving a blood sacrifice to the YouTube algorithm. The robot god accepts sacrifice in the form of liking this video and subscribing to the channel. If you do decide to sacrifice yourself, then please let me know in the comments below. So right now we seem to have everyone screaming at us that the market is over the top in terms of valuation. We've got Graham Stephan saying the stock market has just peaked. We've got PensionCraft saying that the QE bubble has popped. And we have New Money reporting that Michael Burry is now short in the market. You would have thought that the end is nigh. So what should we do? I won't start telling you what to do because I'm not a financial advisor, but I will tell you what I'm currently doing and what I would be doing if I was sat on a large amount of cash at the moment. So let's have a look at some cold hard facts of where the market is right now. So what I've done is I've pulled three graphs from the website currentmarketvaluation.com. It's some really interesting data, so do go check them out. So the first one I've got is purely looking at the PE ratio of the S&P 500. A PE ratio is a price of a share divided by the proportionate earnings. The larger the number, the more expensive the price is. At the moment, the chart is showing that we have the highest PE ratio since the dot-com bubble and far exceeds any time before that since the 50s. In summary, this is saying that the stock market is overvalued, heading into very overvalued. Next, we have the Buffett indicator. It's called this as it was popularised by the famous investor Warren Buffett. The indicator compares the US stock market against its quarterly gross domestic product, commonly known as GDP. As you can see, the dot-com bubble pushed this indicator into very overvalued and then saw a significant bottom after the financial crisis in 2008. Since then, the ratio has crept higher and higher and now is far exceeding the levels we saw in the dot-com bubble and is now very much in the overvalued territory. Lastly, we have a chart that I think is the most interesting. It shows the real S&P value relative to the current interest rates. I think this really helps us put in perspective the historical low interest rates we're seeing at the moment versus the momentum in the market. Based on the low interest rates, this graph is showing that the market is within fair value. So most of the information we have is saying that the market is overvalued, but we are living through very unique times from a historical standpoint, especially with low interest rates. So maybe we haven't got anything relevant to compare it against. There's a lot of things to put you off investing at the moment, I have to admit. But isn't there always something that's going to put you off? Let's have a look at what else has happened over the last 10 years. If you were to look throughout history, then there's always a reason not to buy or to sell. What I have on the screen here is from the Irrelevant Investor, which shows the performance of the S&P 500 with all the reasons not to buy or reasons to sell since 2009. As you can see, there's over 33 reasons why you shouldn't have invested at those points, but look how far we've come since 2009. You can guarantee there'll be many more reasons in the future around not buying or needing to sell, which you won't have thought about right now. All of this uncertainty is a very tough mental barrier to break through, and this is where dollar cost averaging can help. If you don't know what dollar cost averaging is, it's when you put the same amount of money into the market over an equally spaced out time frame. For example, £100 a month or £25 a week. This means you buy more shares when the prices are cheaper and less shares when the prices are more expensive. The result is that your average share price will actually be lower than the average overall. It also has the added benefit of not needing to stress about what the share price is at any given time, as buying the shares when they're overvalued is actually part of the plan. I must stress, this only works if you have a long-term time horizon. This is a plan which I personally follow, which means I invest every month without worrying about it. For me, my ETF of choice is currently trading around £80 a share, and I can't say I'm haunted by the prices I bought for 3 years ago when it was bounced around the £60 mark. You also need to consider the stock market spends roughly 24% of its time within 2% of its all-time highs, which is incredibly often. Being worried to invest at all-time highs may keep you out of the market nearly 1 in every 4 days. If this is going to put you off, then you might not invest at all. This might be extremely challenging if you're in a situation where you have a lot of cash compared to what you already have invested. An example could be that you've recently inherited or you've been saving for a while and you want to start investing. Let me show you the data comparing the best strategies, but then we'll also look at it from an emotional point of view because at the end of the day, we're not computers. Personally, I'd rather have a strategy where I could sleep at night and make less money than to squeak out an additional 0.1% and then having to stress about it. So what does the data show? The data shows that 67% of the time putting all your money into the market as soon as possible beats dollar cost averaging over a period of time. The reason? Well, the opportunity cost is triple whammy. You could miss out on the share price increasing, you're going to miss out on dividend payments, but also remember, your cash has been eroded by inflation. Let's say I suddenly inherited £100,000, which would be twice as much the amount I had invested in the market. I can't honestly say, even with the data in front of me, if I'd have the stomach to put it all in the market at once, especially now. So I'd most likely put it into the market over 12 months equally. If this still then makes me nervous, or you nervous, then spread it out over a longer time horizon. It's not worth investing if it's going to cause you too much stress. In short, if your risk tolerance is higher, then you can lump sum it. If it's lower, then go with dollar cost averaging. Right, onto the Vanguard portfolio update. So what's the share price done over the last week? As you can see from the chart, we actually started at all-time highs after my last upload, hitting around about £80.65, so really good. But then since then we've been on a fairly downwards path, a little bit level, then it's really tailed off in the last few days. So a decline of nearly 2% yesterday, was it the day before now? No, 2% yesterday. And then there's actually been a further decline today that hasn't actually updated my account balance. So you can see on my screen, my balance is currently 50,950, but we need to consider that there's been a decline today, so it'll have a further impact on my balance for tomorrow. So it'll be around about 50,500. This is around about £800 down from my last update, which is a little bit misleading as my direct debit did go out on Tuesday. So in reality, I'm down probably £1,500 since my last update. But that's how the stock market rolls. You've just got to go with the swing of things. In company news, I had 4 of my biggest holdings reporting this week with a combined weighting of just over 8%, so roughly £5,000 of my ETF. First, we had Microsoft release their quarterly results on Tuesday. The update showed that they reached $40 billion in sales for the first time in a single quarter. Off the back of this news, the share price jumped 5% from $227 to $239. However, it has dropped off a little bit since then, in line with the wider market. For Apple, they announced last night that they'd broken nearly every single financial record that they'd previously done, including banking over $110 billion. This beat the expectations of Wall Street, but the shares did still slide backwards by 3% in after hours trading, which does seem a little bit unfair after such a good quarter. But we do need to recognise that Apple were the highest valued company at the start of this year, and they've grown 80% since then, so we can't feel too sorry for them. And then for the first time in recent memory, Tesla have under-delivered versus analyst expectations. Every single quarter they seem to beat, and I thought eventually they're going to have to miss at some point. But for them, the biggest gap was between earnings per share, which was mainly held back for 2 reasons. One, they were selling more cheaper models than expected, and then secondly, there's been a hefty payout for Elon Musk for hitting key incentive milestones. The share price has gone backwards by 5% in after hours trading, but you know what Tesla shares are like, they'll probably go up by 20% by tomorrow. Lastly, we have Facebook. So the results did beat projections, but the mood was dampened slightly by them lowering their forecast for the coming year. This is due to the ongoing political battles, which is adding additional scrutiny to the plans to drive revenue. I did talk about this last week and the need to make WhatsApp profitable. Overall, not a fantastic day across the board, but all companies did hit their targets with the expectations of Tesla. In fairness to Tesla, they did show significant growth versus the same period last year, but I do guess expectations are very high for them due to their valuation. For me, my strategy hasn't changed. I'm going to keep up with my dollar cost averaging strategy, and my money will be going in at the same time next month. So, on to your questions. Man United 099 says, actually before I start, great football team. He says, great video. I invest in VWRL, which is the all-world high dividend yield, as I want the dividends in the future. Also put a little into Life Strategy 100. What are your thoughts? I guess the first one, the high dividend yield. I'm sure there's research out there that shows that high dividend stocks return less value over time compared to moderate or low dividend paying stocks. Again, I can't find the article right now. I have tried for about 10 minutes, so it might be something you want to look into. Part 2, the Life Strategy 100. For me, it's very heavy in the UK, so I think it's weighted about 20% in the UK compared to mine, which is around about 4%. It's not necessarily a bad thing, it's just not what I'm looking for. I'm looking for kind of a slice of the global pie, and that's too heavily weighted in the UK for me. I think the life strategy products are really good for people new to investing as such, or maybe even later in life, who want to have a more of a passive approach, I guess. But for me, I want to hold on to 100% equities as long as possible. And the last question is from Sharon Benjamin, saying, why VWRL over all caps for you? There's very actual little difference if you look in the detail. The main difference being that VWRL lacks the small cap element, which isn't a game changer either way for me, it's just a difference. Purely from a media angle for me, I prefer large caps because in the media a lot of the time, so they tend to get talked about a lot more. I'm more generally informed about them, about what's going on, so I quite like that element, where obviously small caps aren't talked about as much. The one bit that would really sway me though is the ongoing charge figure, which is 0.22% for VWRL and it's 0.23 for all caps. It's barely any difference, but it would be a saving though, which would sway it for me. If you have any questions for next week, then please feel free to put them in the comment section below, and I might actually get around to answering them in next week's episode. Right, that's all for me this week. If you made it this far, then a massive thank you from me. Between my weekly updates, I do post all the content where I can, so the latest one being 5 inconvenient truths about investing to make you rich, which I quite enjoy doing actually. And I've also done a guide on how I made £17,000 outside of my 9 to 5, so why not check them out. That's all from me. See you in the next one.